In the world of investing, it's easy to overlook one of the most critical factors in ensuring your wealth grows efficiently: management fees. These fees, charged by fund managers, often operate behind the scenes and can eat away at your returns over time. The issue isn't just about the initial price tag, it's the long-term drain they can impose on your investment. To protect your wealth and ensure steady growth, we need to establish the 1% wealth rule. This rule is designed to help you make smarter investment choices by keeping your fund's management costs below 1%, ensuring more of your money is working for you, rather than padding the pockets of others. Why fees matter more than you think. Management fees come in various forms: annual charges, commissions, front-load fees, and interest expenses when leverage is involved. While these fees are often justified as the cost of professional expertise, they can significantly reduce your returns if you aren't paying attention. Imagine you've invested in a diversified portfolio, expecting it to grow steadily over the years. Now, let's say you're dealing with a fund that charges an annual management fee of 2%. It may not seem like much, but over the long haul, those fees start to compound and become a substantial drain on your capital. Here's a simple example. Example 1. A 2% fee drain. Consider an investment of $100,000 with an expected return of 8% per year. With a 2% management fee, your fund would only return 6% net of fees. That may seem like a small difference, but over 20 years, that extra fee could cut your potential growth by tens of thousands of dollars. Over time, this difference becomes a glaring hole in your portfolio. By sticking to funds with fees of 1% or less, you ensure more of your money stays invested, growing at its full potential. Example 2. Leverage funds and interest costs. Some funds use leverage, borrowing money, to amplify returns. While leverage can increase profits during good times, it also means you're paying interest on the borrowed funds. Many investors miss the true cost of this interest when looking at a fund's overall fee structure. Imagine investing in a leveraged bond fund that charges a management fee of 1.5%. However, half of that fee is an interest expense. In this case, the effective management fee is only 0.75%, meaning it stays below the critical threshold of 1%. Still, you need to pay attention to the specific breakdown of a fund's fees to understand where your money is really going. The hidden risk of high fees. As much as high fees can erode your returns, there's an even more dangerous risk: opportunity loss. Funds that charge higher management fees often underperform relative to their lower-cost counterparts. Why? Because the additional fees create a drag on performance, leaving less room for growth. This is especially true for actively managed funds that promise higher returns but often fall short after accounting for fees. For example, let's say you're considering an actively managed equity fund with a 1.8% management fee. This fund promises great returns based on the manager's expertise, but after the management fee is taken out, it might only outperform a low-cost index fund, which charges around 0.1% in fees, by a small margin. When you compare the long-term results, you might find that the index fund, despite its lower returns, outpaces the actively managed fund after fees are accounted for. Practical steps to apply the 1% rule. Now that you understand the dangers of high fees, how can you protect yourself? Here are a few practical steps to follow. Avoid funds with fees over 1%. This is the cornerstone of the 1% wealth rule. Whether you're dealing with mutual funds, ETFs, or bond funds, make sure the total management fees are under 1%, excluding interest charges. Look for low-cost options. Many reputable investment firms like Vanguard and Fidelity offer funds with fees well below 1%, but still provide strong performance. Consider funds with passive strategies like index funds, which usually have lower fees and still capture solid market returns. Examine interest costs on leveraged funds. If you're investing in funds that use leverage, make sure you understand the breakdown of their fees. Interest charges can significantly affect the overall cost of the investment, even if the management fee appears to be low. Avoid front-load fees or commissions. These charges can quickly add up and reduce your total returns. Stick with funds that don't charge front-load fees or commissions, which are typically just additional ways for brokers and financial firms to take a slice of your returns. Examples of low-cost funds to help you get started. Here are some real-world examples of funds with low management fees that are worth considering. Schwab US Large Cap ETF, SCHX. Fees: 0.03%. Vanguard Total Bond Market Index Fund, VBTLX. Fees: 0.05%. Fidelity 500 Index Fund, FXAIX. Fees: 0.015%. iShares, MSCI Emerging Markets, ETF, EM. Fees: 0.68%. These funds not only keep fees low, but also provide solid returns that allow your wealth to grow steadily over time. Final thoughts. The long-term impact of low fees, the 1%. Wealth Rule isn't just about avoiding high fees, it's about protecting your wealth over time. By sticking to funds with low management fees, you're giving your investments the best chance to grow without the constant drain of excessive costs. Whether you're building a retirement nest egg or saving for a major life goal, every dollar counts. As you continue to build wealth, remember that fees should never be the reason your investments fall short. Be diligent, understand where your money is going, and make smart, low-cost decisions that will serve you well in the long run.